Hi, this is Maddie Harper bringing you the April 2021 Multifamily Market Insight Report. Nationally, rents increased by 1.6% in April on a year-over-year basis, which is the largest increase that we have seen since the beginning of the pandemic. On a dollar amount basis, rents increased by $10 in April to $1,417, which is the largest monthly increase since June 2015. Jobless claims continued to fall and fell to 553,000 in the week ending April 24th. As the economy continues to recover, many employers are beginning to have difficulty finding workers, especially for low-wage positions. Occupancy declined slightly in March from a year ago, but overall has remained relatively flat during the last year. The top four markets for rent growth remain unchanged in March, with all four top markets continuing to post strong growth. The top three markets, Inland Empire, Sacramento, and Phoenix, have been leading all markets for rent growth for the past few years, and the pandemic has only accelerated that trend. Over a 5-year period, rents in the Inland Empire have increased by 34%, and rents in Sacramento and Phoenix have increased by 34%. To put that in perspective, national rents have increased by 12% over a 5-year period. Atlanta is a new entrant to the top five this month with 6.2% year-over-year rent growth. All gateway markets are beginning to recover, with some further along in the recovery process than others. In New York, month-over-month rents increased by 0.6 this month, which is the largest gain since the beginning of the pandemic. We expect the gains in New York to strengthen as we head into the summer months. Occupancy in New York has bounced back from a low point in August 2020. Occupancy rates have held steady over the last few months. Yardi Matrix did a study detailing occupancy declines across metros. New York had by far the most decreases. Some 857 multifamily properties, or 32.6% of the total in the city, saw a 5% or more decline in occupancy, while 251 properties, or 9.8% of the total, saw a decline of 10% or more. The large drops in occupancy were mainly confined to Manhattan. Based on our analysis, we are forecasting it could take up to 3 years for New York to get back to pre-pandemic occupancy. San Francisco is another gateway market that is showing signs of a recovery. There was a significant increase in month-over-month rents this month, with rents increasing by 0.8%, the largest gain since the beginning of the pandemic. Occupancy seems to have leveled off in San Francisco for now, and our study of occupancy drops in San Francisco led us to discover that 360 properties, or 19.4% of the total, saw a 5% or more decline in occupancy, and 125 properties, or 6.7% of the total, saw a 10% or more decline. While the number of properties with significant occupancy declines isn't as severe as New York, we are still forecasting several years before occupancy gets back to pre-pandemic levels in San Francisco. In Chicago, rents increased by 0.4% on a month-over-month basis, which is another record since the beginning of the pandemic. Occupancy in Chicago was trending up, but began to decline slightly in February and March. In Chicago, we found that 396 properties, or 20.9% of the total, saw a 5% or more decline in occupancy, and 112 properties, or 5.9% of the total, saw a 10% or more drop in occupancy. The good news is that the distress seems to be extremely concentrated in select urban core submarkets, with the further potential distress discussed at the beginning of the pandemic not likely to come to fruition. Thank you for taking the time to listen today. How long do you think it will take for the gateway markets to recover? Feel free to leave a comment below. Thank you.